right, good morning, ladies and gentlemen. Today is March 1st, March 1st, 2023, and I'm back with another edition of the Wednesday live show. And let's see, lots going on. I was looking over at CNBC there. There's some kind of breaking news, and the market's kind of chopping all over the place based on the breaking news. But I have the sound off, obviously, so I don't know what it is. Um, Lots of interesting stuff. Apparently, whatever the news was, just kind of made the market drop real quick, and now it's bouncing so all over the map. Interestingly enough, it seems like we've been in kind of a tight range here lately, and a lot of chop and up and down price movement, and it's kind of weird because the market's actually been acting a little bit dull. It's been acting a little bit dull compared to, oh, I see, it's the ISM manufacturing. Market's been a little dull compared to normally this time of year. It almost acts like we're kind of in summertime market conditions, but who knows. Anyway, a couple things I wanted to mention real quick. And the funny thing is, everybody's talking about, it seems like this past week, what I was talking about on the show the past couple of weeks, and I found this interesting little graphic here about what I was talking about last week, and I mean it's kind of funny, why stocks will crash. But basically what it's showing, the most interesting thing about this is it's a comparison between the 1-year treasury yield and the actual yield on the S&P 500, which is the blue line. And so you can ignore all this, but what the what the author decided to write on the slide is a little assuming stocks are going to crash just because the dividend yield on the treasuries is so much more than the S&P, but it is something to consider. And so, that's definitely a headwind for stocks is obviously what we talked about last week and probably the week before, is that when short-term rates are 0 1% or whatever, then people are forced into risk assets. And now that rates have increased at one of the most dramatic paces in history, going from like nothing to 5%, all of a sudden everyone's talking about treasuries and bonds competing with stocks. And so that's basically kind of a scenario, I think, that to be aware of anyway. So, and I got one more interesting slide before I start the show. Sometimes I try and bring a couple of interesting charts that I find out there on the internet to talk about during the show. And this one's pretty interesting. And last year, you remember we had all those, we had several fairly significant rallies that were based on the idea that the Fed was going to pivot, right? They were going to raise rates to a certain point, and then they were going to pause, and the market is still pricing in rate cuts, and so that date keeps getting pushed back. And the funny thing is that there's a couple of times in 2022 that the market rallied because the consensus is that they were almost done raising rates, and then at some point this year in 2023 that they were going to lower rates again. So they've actually, interestingly enough, the Fed has bought themselves plenty of room now to lower rates if there's some sort of crisis or economic shock, or the economy slows down or goes into a recession. But even as we speak, there's Fed speakers that keep saying that their plan is to hold rates. They're actually going to keep raising rates, right? There's like 2 or 3 more rate hikes priced in, and every single Fed speaker that comes out has said that they're determined, including Powell, to hold rates at these levels throughout the rest of this year. So, but of course, the market over the years doesn't trust that the Fed's going to do what they say. I was about to say doesn't trust the Fed, but over the years they've kind of proven that whatever they've said in the past is not necessarily how they're going to act in the future, because they're very reactive, right? So the old joke used to be, the Fed's hawkish until the market goes down 10%, and then all of a sudden they start cutting rates and they're dovish. So this is a really interesting chart though, because most people aren't aware of this, and the majority of the market declines after the Fed lowers, pivots, which means they've lowered rates, and it kind of makes sense because they typically start lowering rates when the economy goes to hell in a handbasket, right? So when the economy starts slipping into recession and or there's some kind of crisis, then the Fed begins to lower rates, and subsequently the market continues to decline. And so what's interesting about this is it goes all the way back to like the 60s, right? So there's the 1970s. The Fed started lowering rates, the market continued down and was 36% off of, the high. And then you can see where the Fed funds rate, but more interestingly is the most recent couple of big sell-offs here. This would have been like the 2000 dot-com implosion. So market had the huge parabolic run up, and then you had the dot-com implosion, and the market continued to sell off. And the same with the housing bubble. When the housing bubble burst, the Fed was lowering rates, but the market still had a significant decline. And over here, this is the pandemic sell-off, right? So anyways, everyone hoping for a Fed pivot and looking forward to the idea that the Fed's going to lower rates. Well, when the Fed starts lowering rates, look out, because typically they go into, right now they're in a rate hiking cycle in an attempt to bring inflation under control, the inflation they created. So anyway, so here's on the stock charts here. This is a weekly chart of the 1-year Treasury yield. So look at that. I mean, it went from being able to earn nothing on your money risk-free, chased everyone into risk assets, and right around 5%. The same thing I said last week is that little old lady with the $1 million in the bank, all of a sudden, back over here, she couldn't earn enough to live off of by just putting that money in short-term treasuries or, in the bank. But now at 5%, you're talking 50 grand a year on $1 million. So what's interesting about this chart, and it's kind of similar to the chart I pulled up initially. So you remember back here is when they began raising rates from zero, and I'm pretty sure this was the Yellen era. And I remember that, all the times that the market wasn't sure if they'd raise rates, and they took these little baby steps here and there. And as you recall, 2018. So 2018 is when they got from under 2% to a little over 2%, and that was the worst year for the market in ages, right? I think the S&P had, in 2018, had one of its worst years in a long time, and then they started cutting rates back again. And then, of course, there's the pandemic rate cut right there, right? So they basically, rates were still very, very low. But this latest rate hike cycle is pretty amazing, quite frankly. And so pretty amazing as far as the rate of these rate hikes and all those 75 basis point rate hikes and that. And so this is kind of the stock market. Stock market obviously is sort of inverse to this to some degree, right? Because everybody knows as interest rates rise, um, it competes with stocks, right? It competes with risk assets. So this last little leg up here is a little bit concerning because as we see, and then we switch over here, and I'm going to go to a daily chart. So you remember like the little congestion area that I had circled here? Everybody thought that it was going to break to the upside. I mean, honestly, it did look like, it looked like a bull flag. It did. It was a bull flag pattern for the most part, and nice little congestion area there. Everything was looking pretty good, and then of course it broke to the downside, and I'm pretty sure that that's a function of interest rates rising mainly. And because now the market itself is kind of, if interest rates go up and the dollar goes up sort of on a tick by tick, day by day basis, well then the market goes down. So, and there's some other kind of interesting things to note here on this chart that we looked at, and just just to reiterate the point that I was making last week, in the past couple weeks here, is that we had these same sort of little congestion areas. And the most interesting thing about it obviously is that they were like in the same spots, right? Between like just under 4,100 to just around 4,200, right? The same exact levels. And so this was last May and June, and then of course this was basically February. And it's just interesting to me that that particular level was between 4,100 and 4,200 on the S&P was the exact same level that the market rallied up into, consolidated, chopped around, and then broke down from. So this one here, as you may recall, I think I said this last week, that I went and over this amount of time, I tend to forget what exactly caused that sell-off, because that was a runaway sell-off to the downside there. That was incredible. Up here everything was fine. People were like, oh yeah, the market sold off, ran up, consolidated, and then typically, I mean, a lot of times you will see, or we will see, and have observed in the past, that when you get a directional move and then a consolidation for a couple of weeks, the market tends to, this is old technical analysis idea, the market tends to break out of a consolidation in the direction of, the prior trend. That's what like bull flags are all about. And and pennants and that type of thing. You see a stock or the market run up, hit a little pennant or a flag or a, consolidation, and then once it digests that move, well, it tends to break out in the same direction as the prior trend. So that didn't happen back here. That didn't happen here either. And interestingly enough, just about everybody was kind of under the impression it was gonna break to the upside. Hang on just a sec. I'm gonna take a quick phone call here. sorry for the interruption. When the wife calls, I need to take the call regardless of if I'm in the middle of the show. So I had to pause for just a brief moment there and remind her I was in the middle of doing my live show. But anyway, so I don't want to lose my train of thought here. So anyway, I've got something kind of, a lot of times on these charts, for whatever reason, I don't keep my indicator panel open. I guess, it makes the chart a little easier to see, but here's kind of, there's a couple interesting things about this. One is that the MACD, take a look, like this MACD, I love the MACD indicator. Now, I have another chart that's actually got, I suppose I should have pulled that chart up, but I have a chart that's, got the actual MACD crossover lines superimposed with the histogram here. I've always liked the histogram a lot, and basically the way that it works is there's a couple of moving averages, right, that are moving around here, and when the fast moving average crosses to the downside of the slow one, well, then the MACD goes negative and vice versa. So, but interestingly enough, when the MACD goes negative, if you actually pull up the MACD and the histogram and all that, you'll see that, each time going back to, this far, probably even further, each time that MACD went from positive to negative, the market sold off fairly significantly, right? And vice versa. And so you can see what happened back over here. And, the reason I pointed out, I honestly, MACD's always been one of my favorite indicators, and of course it's just an indicator, and all indicators are lagging, and this one's lagging because whatever the market does, the indicator follows. But anyway, so people tend to get really, the peaks in the optimism tend to peak along with the MACD. When it goes negative, it hasn't bode very well for the market, and I think I can probably demonstrate that with, there we go. So there's when the MACD went from positive to negative back in June, but that's that's kind of that's not really as useful because of the speed and severity of that particular sell-off, right? So a couple of these other ones, like right there, where the MACD, let me pull this down here. Down here where the MACD went negative, that was after the big run up, the pivot run up, the Fed's going to pivot narrative run up was basically last summer. And you can see when the MACD went negative there. Now, this little spot right here, you can see just a couple of days. But I mean, that was down at the bottom there, right? So what I'm looking at is like this little tiny 2-day MACD going negative. And it followed like this little bounce off a huge sell-off. So, but anyway, let's go back over here. Look at this one. Same sort of thing. From the low down here at 3,500, market had a fairly significant run up into December, and the fall is typically seasonally a pretty strong time of the year. So anyway, look what happened when that MACD went negative there, right? There was a bounce that didn't quite make it back up to the previous high, or it was like right there. It was a big point of resistance. And so, you can see what happened, pretty big sell down, and then there was that consolidation, and this is the most recent run up, right? This area here. But the thing to sort of be aware of is that, right during this most recent consolidation here, and let me turn, the crosshairs are kind of annoying, but right during this most recent consolidation here, this is where the MACD went negative again, and you can see now we're kind of, we're below 4,000. So, interestingly enough, you remember we talked about S&P 3900 being sort of a line in the sand, right? It was a big it was a big support and resistance point, going all the way back here. And so 4,000 is sort of the over under. And as of right now, there's no telling. We're at 3950 or whatever, and so the market's over the past week or so has been vacillating right around 4,000, and so now this little consolidation area, and I might as well just mark that all the way down to basically the bottom of the box. There was that one day there, that one day where it kind of touched the lower end of the box. So that's kind of a resistance area now. As a matter of fact, it's a significant area of resistance, and it remains to be seen. But interestingly enough, this rally since the beginning of the year was relatively significant, but not all that significant in the big scheme of things. It didn't really compare to last summer's big rally there. That had a lot more oomph to it, and so the market's still in a big annoying range. So there you go. I mean, percentage-wise, I suppose you could say percentage-wise it's significant, but let me just take this all the way back here to point this out. And of course, the bottom of the range, if you wanted a couple pokes below it, but yeah, I mean, so anyway, my point here is this is a pretty annoying range for the market to be trapped in, right? And so the market's in an intermediate term, and how many months are we looking at here? 1, 2, 3, 4, 5, 6 months, 7 months roughly. And I mean, you could theoretically you could take it all the way back there and say that the market's been trapped in this big range here. Percentage-wise, it's relatively significant, but you could even pull that down a little bit. That's a heck of a trading range, and there's been some significant trend moves within that range, but most notably last summer, and then the sell-off into the bear market low. I should have pulled up the chart that has the 200-day moving average, or the moving averages on it, because I saw a statistic yesterday that I thought was kind of interesting, and someone pointed out that since 1960, I love the way they cherry pick these statistics, but since 1960, no bear market has gone on to make a new low after the price spends a month over the 200-day moving average. So let me go ahead and let me find a different chart here. I have a chart that has the moving averages. Yeah, this is what I was looking for. And of course, it has the RSI at the bottom. Let me pull this down a little bit to make it easier to see. Yeah, so you talk about no man's land here. This is probably the most interesting spot where we are right now. First of all, look at this golden cross here, right? So, the golden cross, when the 50-day crosses up through the 200-day moving average, that's what's commonly referred to as the golden cross. And so I looked through a whole bunch of individual stock charts once that had golden crosses, 10, 20 days prior, and I determined from my own observation that the golden cross is completely meaningless. for the most part. But you can always go back and say, well, every big market move to the upside with started with a golden cross. Um, but anyway, here's the funny thing about this. Not really funny, but the interesting thing is that anybody that got all excited because the market made a golden cross, and decided, well, now's the time to buy because we just got a golden cross. Well, they literally like bought the peak of this current market cycle. So let that be a lesson. So now, this is what's so interesting is that, a couple days ago, or actually this would have been last week, but on Friday, the price literally 50-day moving average above, 200-day moving average below. And it traversed that entire range from high to low. And so it's just funny because the market, I remember that, it was just a few days back, and so the market was kind of, selling off big time, and then as soon as the lows started getting down to where the 200-day moving average was, then the buy programs kicked in. So, somebody out there somewhere had their algos programmed to buy at the 200-day moving average from above, and so that kind of supported things. And then, on Monday, we were above and below the 50-day moving average, and yesterday, above and below the 50-day. And so here we are today, right back in Friday's range where the price is actually trapped inside that 200-day and 50-day moving average. So that's it's kind of interesting to see, quite honestly. Um, earnings season's starting to wrap up, and I read so many mixed messages when it comes to earnings season. I read a lot of different stuff. You'll see earnings season's better than expected, but the expectations, they get managed, and then you got GAAP earnings and non-GAAP earnings and all this kind of stuff. But basically S&P earnings have come down, which is also, kind of a headwind. We talked about higher treasury yields and bond yields being a headwind. Well, the fact that earnings have been declining are also sort of a headwind. And then you throw in everything has to be measured in terms of inflation. And so, these companies come out and they're like, sales increased, 6% year over year. And then you have to wonder, well, wait a minute. If inflation was 6%, your sales should increase 6% just to stay where you were last year. So everything, and especially data, like I said before, that statistic that I mentioned a minute ago, that statistic about the S&P has never spent a whole month over the 200-day moving average and gone on to make a new low, right? Like a bear market rally has never spent a month over the 200-day and gone on to make a new low since 1960. And so that's the thing. There's a saying about damn lies, and statistics. And so the stock market has more statistics than Major League Baseball, and you can pretty much come up with, whatever sort of picture you want to paint based on those statistics. So anyway, we're kind of in no man's land here. Interestingly enough, when I was looking at this chart, over the weekend, and actually on Monday, it was more like on Monday, when I was looking at the chart on Monday, I was thinking to myself, and I looked at a bunch of candlestick charts too, I was thinking, wow, man, that's a perfect, ideal textbook pivot low, right? If I change this to candles. Yeah, I mean, it's kind of a textbook pivot low. Now, there's a lot of, waffling around here. This is something else that's kind of interesting to look at is, the long range days with the filled in bars. And quite frankly, I mean, I usually turn my green bars to filled in, but it's interesting how the market is kind of waffling around here with these narrow body days. But anyway, I was looking through a bunch of charts And, there's a lot of stocks that also have like these sort of textbook pivot lows. And the fact that there was a textbook pivot low right at the 200-day moving average, I think gave some people some optimism. But here we are a couple days later, and we're sort of retesting these areas. And so it's going to be interesting to see what happens. In the very near term, obviously, very near term, the market's in kind of a near term downtrend. And so, going back to kind of where we are now, theoretically, the market's going to need to sort of break out of, and it's entirely possible, right? Now, of course, there's a lot of crazy stuff going on in the world, and market has so many headwinds going, but the macro picture's one thing, and the macro picture is one thing, and basically, in the very near term, there could be any number of things that that cause them out or to create a rally back up to underneath that resistance area, but it's looking a little dicey, right? So the last thing I'm going to talk about here is this consolidation area. So, I drew the big sort of consolidation area above. I drew that box above as resistance, right? So, yeah, that's what I mean by the market just kind of trapped in a range. And these ranges can be boring, they can be kind of insidious, they can be tedious. Typically, we see range bound markets in the summertime a lot of times when the participation's kind of dull or whatever. But so you got big area of overhead resistance above. You've got this kind of, the back there, 3,900. We spent a lot of time last year talking about the 3,900 level, which is kind of, the top of this area. And so you're in no man's land. You got resistance above, support below, and you zoom into the moving average time frame, and you got the same thing. You got support below, resistance a little bit above. We're chopping around the 200 and the 50 days, so it's going to be interesting to see what happens if this thing actually does break down. I mean, in the very near term, obviously, we're in a near-term downtrend, intermediate-term downtrend. There's a few ways to draw a downward sloping trend line. Quite frankly, we need some sort of a bounce to even know what kind of angle to put on this thing. I mean, obviously we could take this and we could put it kind of actually fits at a much higher sort of angle like this, and so same sort of thing, overhead resistance. We'll just have to see what happens. So I don't think right now is a time to get really aggressive. Is, I guess, the takeaway from this. It's not a good time to be really aggressive. It's not necessarily a great time. I see a lot of charts that are kind of setting up, right? We have a couple open trades that we're doing okay as of yesterday. So that's a positive sign, but as far as the market breaking out of this range to the upside, it didn't happen, and so we want to be a little bit cautious here based on everything that I've just talked about and the fact that right now we're in kind of a near-term downtrend here. So we'll just have to see. Anyway, phone calls keep coming in here, so I should probably just go ahead and wrap this up. So thanks for tuning in. I will see you back here